So in this video, we talk about understanding personal finance. There are five pillars to personal finance: earning, spending, borrowing, saving, and investing. Earning, well, we work and we get paid, and we refer to that as income. And we get paid through a paycheck. And one of the reasons that we get paid through a paycheck is because it's an evidence of payment from an employer to an employee. And also, the government likes to keep track of the payments between an employer and employee. There are certain payments that the employer has to make on behalf of the employee, payroll taxes. That includes Medicare, Medicaid, unemployment insurance, and certain levels of taxes. One of the ways to cash a paycheck is through a checking account that you can have with a bank, with a commercial bank. And a lot of these checking accounts will have certain level of costs because they offer you a service. So the checking account is basically um, where you can keep your money safely. The government will insure up to $250,000 that your money is secure. A checking account can give you a checkbook where you can write checks and pay others. And as you write checks, it is a evidence of payment. However, writing a check has certain security problems, so you should be very careful about obtaining a checkbook and writing checks. Um, a checkbook can become a serious responsibility. So unless you absolutely need it, I'm not really sure if a checkbook is an absolute necessity. But nevertheless, a checking account allows you to have a checkbook. It has a usual cost. Some banks will basically waive that cost if you were to keep certain level of money in it, or if you get paid through a direct deposit instead of a paycheck. Um, or they will have certain waivers based on your age, or if you're a student, and so on and so forth. So every bank is different, and they will have different costs and different waivers of costs or conditions to waive the cost. But obviously, one of the best benefits of a checking account is you don't have to carry cash with you. It may give you a debit card or an ATM card where you could access your money through ATMs of your bank. And so it's quite convenient. Note, however, that if you actually use an ATM that belongs to another bank or that belongs to an ATM company, the ATM can charge you a fee, and these fees may add up. So you may want to open a checking account with an institution, with a bank that is familiar to you, that has a branch near you, or that has an ATM machine near you. And also, when you're opening an account, just make sure that you know all the associated costs. You ask and you talk about them. Ask them how often they charge the cost, if there are any waivers. Um, Tell them that you are a student, if you are a student, and then your age might also be one of the reasons that they could waive the costs. Everybody pays taxes. In fact, it is one of the civic duties that we do. That's how our government works and operates and provides services for us. And everybody pays whatever taxes they um, allocated to pay. However, there are certain deductions that every US citizen has. Some of these are just minimum living standards. Some of them to do with healthcare costs. Some of them to do with number of dependents we have, how many kids you have, if you are married and filing jointly, or if you're married and filing separately. Everybody has different deductions, but there are certain of them that are quite common. So you will be surprised how much of a deductions everybody gets. So even if you think that you actually made a lot of money and then you predict that you're going to owe a lot of taxes, it might actually turn out that your deductions are more than you thought, and you may end up not paying any taxes or not owing any taxes at all. So these deductions are actually quite generous. But we file for taxes every year. It is based on the income that you make, and any income that you earn through either a paycheck, through your work, or through your investments, or through any sort of income that you make, a certain level of tax accrues. And once a year, we basically tell the Internal Revenue Service, IRS, how much we made and how much we owe, and we calculate and we file a form called 1040EZ. Um, we'll talk about in later weeks about taxes, but it's an annual responsibility, and we pay it usually between the months of February, March, and sometimes till the mid-April. Uh, the, the, the time, the tax season beginning and ending time is usually announced by IRS. So how about spending? Well, obviously, everybody likes spending money. But there are certain necessities that we have to spend, like food and security and transportation, insurance, and that sort of thing. Obviously, we need to make sure how much money we spend, and we want to make sure that we don't spend more than we make. So we try to optimize our budget. So we talk about a budget. So what's a budget? A budget is, looking at your income, looking at your expenses, and hopefully having a balance. But literally writing it down. How much money you make, your work, your income, whatever pluses that you have on your budget, and then you write down your necessity expenses. And if you have any surplus, then you can talk about spending for luxury, perhaps indulging on certain luxury items and so on and so forth. But the budget can be a short term or a long term. Short term usually is monthly. You basically are trying to make ends meet for the duration of the month. If you have a paycheck that you have or you receive on a weekly basis, then your budget may be weekly. How much money you need to spend in that week and how much money you make in that week. It always is a good idea to write it down, and so that you can actually see how much money coming in, how much money going out, and then you can see if you have a deficit or a surplus. A deficit means that you actually spend or you need to spend more than you make. Therefore, you're in the red, you have a deficit. A surplus means that you actually make more money than you spend, which is good so that you can actually save. Um, but obviously, budget is a good idea so you know how much money you have left after writing down all your income and all your expenses. And if you're short, then you know how much money you need more to make, right? Then when you have a deficit, you may need to borrow. So there are different ways that we borrow and different purposes. One of the most common, and everybody basically knows about the credit cards, but different banks and institutions can offer you credit cards. You can get a credit card from department stores like J.C. Penney or Sears, or you could get a credit card from Chase or Bank of America or Capital One, commercial banks. Sometimes these credit cards will be free. um, Basically just give you a card and give you a credit limit, and they let you spend, but you need to pay it back. But sometimes it's going to have a cost. They're going to say, we'll charge you $100 a year if you don't spend anything on it, even if you don't spend anything on it. So be careful as to what credit card you're getting, how much of a credit limit you have, and what sort of a cost it bears. Because once you sign the agreement, you have to pay that fee, you have to pay that cost. These costs can be substantial. There are credit cards out there that require you to pay few $1,000s a year just because you have the card, and not necessarily you spend anything on it. So you get the card, you sign it, it's yours. Now you owe us $1,000, that sort of thing. So be careful as to what credit cards you apply for, what sort of cost they have, and do you have to pay them every month? Do you have to pay them every year? How much is it? And that sort of thing. It has certain benefits, and you again need to read about this because every credit card is different. It depends on the bank that's offering it to you. It depends on whether it is a department store credit card or a bank credit card. But a lot of the times, one of the benefits that you're going to get is um, that the credit card will go through a major processing company like Visa or MasterCard. So the credit card may be issued by a commercial bank like Chase. So you may actually get a credit card from Chase, but it will have a Visa logo on it or a MasterCard logo on it. So the Visa and the MasterCard are the major credit card processing companies. They may actually offer you benefits. The company who you gotten the credit card from may offer you benefits. So what are some of these benefits? There could be rebates. Um, for every $1,000 that you spend, we'll give you $10 back. That sort of thing. They may add up, but be careful. Anytime there are benefits, there are definitely costs. I haven't came across any credit card that's for free that offer you any sort of meaningful benefits. So you need to balance out how much cost you're paying and how much benefits you're getting. Some credit cards will give you miles so that you could buy cheap airfare or upgrades and so on and so forth. Some credit cards will give you insurance on some products that you buy or travel reservations that you make or a rental car that you rent. But these may have fine print, so be very careful. I came across a few credit cards that they offer, insurance for cars that you rent, but the fine print was so fine that you have to read it. For instance, if they don't pay scratches on the paint, where the rental company may charge for them. So while you're thinking you're insured because of your credit card, you really are not. So you may want to read these well, but overall, a credit card may offer you several benefits, and you should be aware of them because they may become very, very handy, and they may come with a cost. One of the dangers of a credit card, obviously, is that you feel like you have the money, but keep in mind that you're actually spending borrowed funds. You don't have the money. You're basically spending the money that you do not have. And that's dangerous because then you can actually start to add up credit card debt. If you're not careful, pretty soon you can realize that you actually have a second card, a third card, a fourth card, a fifth card, and all of a sudden your credit card debts are so much that you simply cannot even pay the minimum payments. A credit card will require you to make at least one monthly minimum payment. That usually is about a certain percentage of the account for the debt that you have. And if you don't pay it, then you go into default. The interest rate on the credit card is the highest that there is out there. So currently, for instance, if you have a savings account, which we're going to talk in a minute, you earn very, very little. For every $100 that you keep, at the end of the year, they'll give you a 20 cents interest. But on a credit card, for every $100 that you owe, they're going to charge you $24 on average, and then sometimes more on interest. Let me repeat that. For a savings account that you keep, for every $100 that you keep, at the end of the year, you probably will get somewhere around 20 cents as an interest income. But on a credit card, for every $100 that you owe and keep it as outstanding balance, you're going to end up paying at the end of the year on a monthly basis about, all in all, in 1 year, you'll end up paying about 24 to 25 and perhaps more dollars as an interest on your debt. That's the average. So that's how outrageous the credit card interest rates are. It is a quite literally a financial trap. However, you kind of need to have a credit card to build yourself a credit history so that you could get a car loan and you could ultimately apply for a mortgage to buy a house. So, a good, disciplined usage of a credit card um, can give you benefits while you're spending it. And as long as you spend no more than you make, You could build a good credit history, which ultimately you can buy using that credit line or credit history. You could apply for a car loan and buy a car, or you could apply for a mortgage and buy a house. So this is the borrowing. Now, with respect to saving in your budget, weekly, bi-weekly, or monthly, if you have more money than you spend, then you can actually start saving. And you look at savings accounts that certain banks, commercial banks like Chase, Capital One, Bank of America, HSBC offer. Um, Most of these savings accounts will have a certain level of cost, which again can be waived because you're a student or you're of a certain age or you make certain amount of money or you have certain level of money in your account. But one of the best benefits that these savings accounts offer is they pay you a teeny bitty interest. So that's not really the benefit. The benefit is your money is safe. You're not keeping it at home. You're not keeping it in your pocket. You're not keeping it on your person. You're basically keeping it at a financial institution. And up to $250,000, the government will give you a guarantee that your money is not going to be, um, lost because the bank has bankrupted, right? So savings account will give you a security as to your money. It's better than keeping it at home, better than keeping it on you, better than carrying it around. So however much money you have, a savings account will keep it safe for you. It's very important to have an emergency fund for a rainy day. Um, However much you can, but usually, you know, you should think of obviously to save as much as you can, but it's not always possible, obviously, to save everything you make. Uh, but at a very minimum, you need to have an emergency fund for a rainy day. You should have certain target, um, perhaps short-term targets. Like, one of my targets is at the end of the month, I don't want to spend more than I make. I really don't want to have any sort of a debt at the end of the month. That's my target. I can't meet it every month, but the months that I do, I'm very happy. Long-term targets, I'm kind of hoping that at the end of the year, for instance, I could save a little bit of money on the side. I could at least be proud that I didn't dip into my emergency fund, and maybe I indulged to a dinner outside or whatnot. So the targets obviously are dependent on the person, short term or long term. But it is nice to have these targets so you can actually meet these targets. And when you do, you could be proud of yourself with your financial success. And then you could raise the bar a little bit every month or every week as you meet your target. And then if you cannot meet them, then you could actually think about how you can meet them. Maybe get a better paying job, invest in an education so that you could get a better paying job, or perhaps getting a second job, or um, you do something extra, maybe investing, right? So these are the savings. Now, how about investing? I just talked about investing. Well, there are brokerage companies out there that allow you to invest in stocks and bonds and that sort of stuff. And I know that this may be really early to talk about this, as our future courses, we will talk more about this. But the brokerage accounts became very, very popular. Companies like TD Ameritrade, Schwab, Fidelity, they offer accounts very similar to commercial banks, actually. But the main difference between a checking, savings, and a brokerage account is that the checking account gives you immediate access to your money. You can write a check against it. They give you a debit card so you can act, or an ATM card so you can withdraw your money. A savings account is hidden away. It's much, much safer than a checking account. And you don't have immediate access to it always. Not as easy as a checking account. But still, you can have an access daily. But a brokerage account is a little bit more restricted. You don't have as access to it as easy as a checking or a savings account. But with a brokerage account, you can buy a stock that could give you an income. You could buy a bond that could give you an income, and that sort of thing. Brokerage accounts also have certain level of costs, so you need to read about it. Some companies will just simply say, if you don't do anything, if you don't have any money, we'll charge you $50 a month. So they could be expensive. But then again, you need to read the actual fine print and see what they're costing you, because signing a contract. The benefits are some of these brokerage accounts can be used as checking account. They can also be used as savings accounts. In fact, some of these brokerage companies now act as a commercial bank. So you could combine all three into a single account and have a debit card or a check book with a brokerage account. But it's important to learn how to invest. If you start having those surpluses in your budget, if you have that additional income, if you can set aside some savings, learning to invest would actually allow you to earn money with your own money. And however little you have, however much you have, earning the extra dime will always be, to be an addition to your budget. So we talked about the introduction to our personal finance. We talked about earnings and paycheck, their checking account. And then we talked about spending, having a budget, having a short-term goal and a long-term goal, and certain level of budgetary targets. We talked about borrowing, through a credit card, the dangers of a credit card, the financial trap, if you will, and then the importance of building a credit history. And again, we'll talk about this significantly more in later weeks. Then we talked about savings, saving in a savings account, or in a brokerage account. And these are the five pillars of personal finance. So thank you for watching, and I'll see you next week. Thank you.